Welcome to the Unconventional Wisdom Podcast with Ed Rempel, the show about the most effective methods to achieve financial security and freedom. Find out what really works. Insights are based on in-depth experience from a fee-for-service financial planner, tax accountant, Canada's #1 financial planner blogger, and your host, Ed Rempel. The Smith Manoeuvre. Is your mortgage tax deductible? The Smith Manoeuvre is an efficient strategy to use equity in your home to invest for your future without using your cash flow. It converts your mortgage over time into a tax-deductible investment credit line. Most Canadians are searching for a feeling of financial security, but all the bills and life expenses mean they never build up enough of a nest egg to be secure. So the Smith Manoeuvre is a strategy that can help you build your nest egg and help you achieve the retirement you want without using your cash flow. We've been using it extensively, and it's a quirky name, but it's surprising how well it works in practice. So we've become known as experts in the Smith Manoeuvre, having helped hundreds of Canadian families implement it. It's one of the most effective wealth-building strategies when done by the right people in the right way over the long term. What you'll learn in this video is, what is the Smith Manoeuvre? What are the benefits? What are the risks? How do you manage the risks? How do you implement it? How do you avoid having to use your cash flow? How long should you ideally do the Smith Manoeuvre? Are there really 8 Smith Manoeuvre strategies? Is it legal? What's the best way to invest with the Smith Manoeuvre? And how can I learn more and find out whether the Smith Manoeuvre is right for me? So first, what is the Smith Manoeuvre? In short, the Smith Manoeuvre involves borrowing the available equity in your home to invest bit by bit as you gain equity with each mortgage payment. As your mortgage declines, it's replaced by a tax-deductible credit line from money borrowed to invest. So your total debt stays about the same. You can borrow from the credit line to pay its own interest, which is called capitalizing the interest. So it does not normally require any of your cash flow. The interest tax deductions can give you tax refunds, which you can use to pay down your mortgage more quickly. Over time, your investments can build up a large nest egg that can help fund the retirement you want. It's best to consider it as part of a retirement plan. We've helped thousands of Canadians plan for their retirement and found that many people are unable to invest enough to be able to have the retirement they want without a significant effect on their lifestyle. In many cases, the Smith Manoeuvre can fill the gap by providing enough additional investments for them to achieve their desired retirement. So this means they can continue to live their lifestyle now and still be on track for the retirement they want. Now, I talk with people all the time whose main financial goal, if they have one at all, is a general desire to somehow pay off their mortgage as soon as possible, and then they can finally start saving for retirement. But it's increasingly clear that much of Canada's hardworking middle class continues to face underfunded golden years simply because they run out of time. One of the main benefits of the Smith Manoeuvre is that it can help you start saving for your retirement now, not 20 years from now. Long-term returns on the stock market have been far higher than typical borrowing rates, so you could earn a surprisingly large benefit over time, especially when you include the tax benefits. For you to have a very high chance of success long-term with the Smith Manoeuvre, it's important to be the right type of person, have the right outlook, and set it up properly. Borrowing to invest is inherently risky. It should never be done just for the tax deductions. The risks decline considerably with time, however. The stock market fluctuates widely in one-year periods, but the worst 25-year calendar return of the S&P 500 in the last 90 years has been a gain of 7.9% per year. This is why the Smith Manoeuvre is generally only suitable for people with a high-risk tolerance and a longer time horizon. I suggest committing to a minimum of 20 years. Now, the general rule of thumb is that your investments need a long-term return of only 2/3 of the average interest rate on your secured credit line for you to break even over time after tax. For example, if the interest rate is 6% on your credit line and you are in a 40% tax bracket, you only need to invest to earn about more than 4% per year long term after tax to benefit from the Smith Manoeuvre after 25 years. That's quite a low hurdle. If you'd like to learn more about the Smith Manoeuvre and whether it's suitable for you, the best way is to watch this video in detail. I'm trying to make it the most complete source on the internet. It's the best source for accurate information about the strategy. When it comes to the Smith Manoeuvre, to my knowledge, we are the leading experts in Canada, the only financial planner combining it with comprehensive financial planning, and the only source for all 8 Smith Manoeuvre strategies. So I'm recognized by Fraser Smith in his book, The Smith Manoeuvre, on page 82. That's the 4th printing that came out in July 2005. So what are the benefits? Most discussions about the Smith Manoeuvre recommend it as a way to make your mortgage tax deductible like our American friends have, but it does not actually do that. So it converts your mortgage over time into a credit line used to borrow to invest for your future. The interest on the credit line is normally tax deductible. So it's not your mortgage itself that becomes deductible, it's the credit line that replaces it. So now 3 main benefits of the Smith Manoeuvre are: invest for your future without using your cash flow. That's the main one. Tax deductions, and you can pay off your mortgage faster. The main benefit comes from the long-term compound growth of your investments, which is normally far more than your extra tax refunds. For this reason, you should think of the Smith Manoeuvre primarily as a strategy of borrowing to invest for your future. The tax deduction should not be your main reason for implementing it. When we model the Smith Manoeuvre over 20-year, 5-year periods, typically only 20% of the benefit is from tax savings and 80% is from the difference between the long-term compound investment growth and the interest cost. Interest on money borrowed to invest is, however, one of the only tax deductions that's available to all taxpayers. People that earn salaries usually have few options other than RSPs to reduce their taxes. So people who are retired often have no deductions at all, but can still claim their interest tax deductions if they maintain Smith Manoeuvre during retirement. So the long-term benefits can be significant, though. Starting with home equity of only 20%, the expected benefit of the basic plain Jane version of the Smith Manoeuvre over 25 years is roughly equal to the value of your home today without using your cash flow. So it's significant. Starting with a lump sum or doing a more aggressive version can yield much higher benefits. So what are the risks? The long-term growth and tax refunds are nice, but borrowing to invest is not for everyone. The Smith Manoeuvre is a risky strategy because you're borrowing to invest. It magnifies your gains and your losses a lot and can easily double or triple your profit or your loss. You owe the balance of the loan and interest regardless of how your investments perform. The biggest risk to the Smith Manoeuvre, however, is you. If you are the type of person that might panic and sell during a large market crash, then the Smith Manoeuvre is not right for you. If you do it for 30 years, there will likely be a few market crashes during that time, and you need to be able to stay invested right through them. To consider this type of strategy, you need to be able to tolerate the ups and downs of your investments and stay invested for the long term, especially after any market crash, or if the value of your investment falls below the amount you owe on the credit line. So ideally, whenever the market is down, you would buy more, not think about selling. The biggest problem with borrowing to invest is that investors often do it at the worst possible time and not for the long term. Investors are often drawn to it after stock markets have been rising strongly for several years. Stocks can feel safer in strong bull markets, but this is the riskiest time to invest. We had one guy come to me once that was saying, well, let me try it for a year or two and see how it goes. I told him, well, don't even start if that's what you're thinking, because I don't know what the market is going to do in 1 or 2 years. But, based on history, after 25 years, it's been between 7 and 17 times higher. It's going to be way higher in 25 years. So if you're not going to stay in that long, don't even start. How do you manage the risks? The best way to deal with the risks is to invest for the long term and have a sound investment strategy. It is most effective for the Smith Manoeuvre to be part of your financial plan, to give you the long-term outlook, and to work with a financial planning and tax professional to make sure it's set up properly and follow all the rules. In general, you should only consider the Smith Manoeuvre if you're planning to stick with it for a minimum of 20 years and preferably much longer. You need to have the emotional and financial strength necessary to maintain this as a long-term strategy. The Smith Manoeuvre is an efficient way of borrowing to invest, so it's only suitable for people that have a high risk tolerance. From my experience, it works best with people that are optimistic about the future, have reasonable understanding of long-term stock market history, a long-term outlook, and that consider it to be a key part of their retirement plan. While the stock market's volatile, the long-term risk is far lower than most people believe. If you invest for 20 years or more, the range of historical returns, like standard deviation of stocks after inflation, is actually lower than with bonds after 20 years. The companies on the stock market tend to do anything they can to keep growing their profits. After a downturn, which is the main reason the stock market has historically reliably recovered from all declines. How do you implement it? So first thing is, to implement it, you need a readvanceable mortgage, which is a mortgage linked with a credit line. Readvanceable mortgages are available from most banks. I have a post rating of readvanceable mortgages to help you get the best one. The credit limit for your mortgage plus the credit line is normally 80% of the appraised value of your home. Note there's new OSFI rules, mortgage rules, I did a video on it, that reduce the credit line to 65% over time, but still allows you to start with a combined limit of 80% of the value of your home. And you can bring it back to 80% if you want. In the plain Jane Smith maneuver, with each mortgage payment, you pay down some principal, which immediately becomes available in the credit line. You can borrow this amount to invest directly from the credit line. For example, if your mortgage payment's $1,000 biweekly and the principal portion is $500 biweekly, as soon as you make the mortgage payment, you gain $500 of credit in the credit line linked to your mortgage. You can then borrow $500 biweekly from the credit line to invest. If you invest biweekly or monthly in this way, you get the dollar cost averaging benefit of a lower average cost, which makes this a safer way to invest than investing one lump sum. Your investment credit line interest is normally tax deductible, so you should start receiving refunds. They may be very small in the early years. In the classic Smith Maneuver scenario, you'd use your tax refunds to pay down your mortgage and then immediately reborrow the same amount from your credit line to invest. In practice, you should look at your entire financial situation and use the tax refund in the most effective way. If you use only tax refunds for the basic Smith Maneuver to pay your mortgage more quickly, you generally pay off your 25-year mortgage about 3 years sooner. If you need help in getting the best readvanceable mortgage for your situation, check out my free Ed's Mortgage referral service. It's on my blog. I know the advantages and disadvantages of all the readvanceable mortgages available in Canada and have contacts and experience with most of them. How do you avoid having to use your cash flow? The Smith Maneuver can normally be done without using your cash flow if you capitalize the interest, which is what we call it. This means you borrow from the credit line to pay the interest on the credit line. It pays its own interest. There's a tax advantage for doing this. The tax rule is that if your interest on your credit line is tax deductible, then the interest on the interest is also tax deductible. There are usually more effective uses for your cash flow than paying low interest, tax deductible interest, like low rate tax deductible interest, such as paying off non-deductible debt or investing in your RSP. So it's very useful. You don't need to use any cash flow for the Smith Maneuver. The key issue with capitalizing interest is tracking. You need to be able to track that the money you borrowed was used to pay the interest. Banks generally will not allow you to automatically use the credit line to pay its own interest, so you need to guerrilla capitalize the interest, which is what we call it, which means you do it as a manual transaction. Have the interest paid from your checking, but then withdraw the exact same amount to the penny from your credit line to replenish your checking account. A better way is to have a dedicated Smith Maneuver checking account that is used only for these transactions, so all the money going in and out is only for the Smith Maneuver. How long should you ideally do the Smith Maneuver? If the Smith Maneuver is a suitable strategy for you, then you can get the maximum benefit by maintaining it as long as you own your home. This can include maintaining it right through retirement. You can keep the tax-deductible credit line or mortgage during retirement when you may not have any other tax deductions. You can eventually pay it off when you sell your home, not by selling investments. This is a different way of thinking. Instead of trying to pay off non-deductible debt, you plan to keep tax-deductible debt as long as possible so that you can keep your investments as long as possible. It's the investments that provide your retirement cash flow. Maintaining your Smith Maneuver for life, or as long as you own a home, offers you the maximum long-term benefits. So are there really 8 Smith Maneuver strategies? So the Smith Maneuver is not just one strategy. There are actually 8 categories of Smith Maneuver strategies, each of which can be done large or small. The variations are limited only by our imagination, but here are the main categories of strategies. Number 1, the plain Jane Smith Maneuver. This is the basic original Smith Maneuver, starting with zero and investing biweekly or monthly the principal portion of each mortgage payment. The standard way is to invest up to 80% of your home value. You can, of course, borrow to invest significantly less if 80% is uncomfortable for you, or more if your goal is to build a larger nest egg over time. Number 2, the Singleton Shuffle or Flintstone Flip. We've got some funny names for this one, but basically you can convert part of your mortgage to a tax-deductible credit line instantly if you have non-registered investments. To do this, sell the investments to pay down your mortgage, then immediately re-borrow the same amount from the credit line to reinvest. This gives you the same amount of investments and the same amount of debt, but now part of your debt is tax-deductible. When we met Frank and Isabel, they had a $100,000 mortgage and $100,000 investments at the same bank branch. We recommended they sell the investments to pay off the mortgage, then immediately borrowed $100,000 again to invest. They still had $100,000 investments and $100,000 debt, but the new mortgage interest is now tax deductible because it was used to buy investments. It is usually a good idea to use any non-registered investments to convert part of your mortgage to tax deductible as you start the Smith Maneuver, unless you have specific other purposes for it. Number 3, the top-up. You can kickstart the Smith Maneuver if you have additional equity in your home. You can borrow the available credit in your credit line to invest so that you can start with a lump sum. This normally requires no cash flow since you can still capitalize the interest. Number 4, the debt miracle. If you have other non-deductible debts and some home equity available, you can merge all the debts and payments into your new mortgage. You refinance all the debt at lower rates in the new mortgage, plus you're effectively converting all the debts to tax-deductible interest over time. This can make your monthly Smith Maneuver investment very large. So when we met Stefan and Maureen, they were struggling with debt payments and not able to invest much. They had a $1,000 per month mortgage payment, $500 per month for a car loan, $250 per month for a credit line, $250 a month for a credit card. So we merged all their debts into the mortgage and kept the payment at $2,000 per month. So the new mortgage payment was the combined payment of all their debts otherwise. This is the same payment, but now $1,500 per month is the principal portion, which allowed Stefan and Maureen to invest $1,500 per month with the Smith Maneuver. The strategy can be a miracle sometimes. For Stefan and Maureen, they were struggling with a bunch of debt payments and unable to invest for their future at all. With the debt miracle, they had one low interest debt, and they were investing $1,500 a month for their retirement. Smith Maneuver with dividends. This is method number 5. If your objective is more about paying down your mortgage and not about maximizing your benefit, you can invest entirely in dividend-paying investments. You can use the dividends to pay down your mortgage more quickly and then immediately reborrow the same amounts to invest. Your overall benefit from this strategy is reduced by the tax drag from the tax on the dividends every year, which reduces your tax refunds. Dividends are generally taxed at low rates, but at much higher rates than deferred capital gains, which are the norm with the Smith Maneuver. So the lowest tax type of investment income, I have a video about it, is deferred capital gains, because the lower tax on capital gains and that you can pay it many years from now. Some people implement the Smith Maneuver using dividend-paying stocks, ETFs, or mutual funds. Dividend investing has historically been a relatively effective way to invest since it generally means you're investing in larger, more stable, and slower-growing companies. However, dividends are fully taxable every year unless they are from Canadian companies. Most people that invest for dividends end up non-diversified because they end up investing entirely in Canada. Canadian stocks have generally had significantly lower returns than global or U.S. stocks. The expected benefit from the Smith Maneuver with dividends is generally lower than the other strategy here because of the tax drag, sometimes called the tax bleed. I modeled it. I found that the dividend investments would have to earn about 1% per year more than tax-efficient growth investments over time to get the same benefit. This is true even though your mortgage is converted to tax-deductible more quickly because of both lower expected returns and the tax bleed. So, with the dividends, you can actually, because they're taxable, you can actually pay them on the mortgage and that everything stays tax deductible and reborrow, so you're converting it more quickly. But the tax bleed tends to be a bigger factor than that. So that's why you have to make a higher rate of return to be the same point. Okay, strategy number 6, Smith Snyder. After you retire, you can take income from your leverage investments either by selling a bit every month. We call this self-made dividends. I have a video about that. Or buying investments that pay out a significant monthly amount. One example is the T8 mutual funds that pay out 8% of the balance each year. There are a variety of ETFs with large monthly payments. Most of these payments are return of capital, which we call ROC, which creates a tax issue. ROC is tax deferred for about 12 and a half years with an 8% payout, so it's tax free when you get it, but it reduces the amount of your credit line that's tax deductible, and it's up to you to track it. If you maintain the Smith Manoeuvre investments into retirement, then this is one of the options for receiving retirement income. We use this for retired clients who maintain the Smith Manoeuvre, but track the tax deductibility of the credit line in a huge spreadsheet. So this strategy was heavily marketed in the past as a way to pay off your mortgage more quickly, but actually it has no benefits unless you need the cash flow. So the return of capital, or ROC, means the original loan or credit line becomes non-deductible over time. So for tax purposes, paying a return of capital payment onto your mortgage is the same as cashing your investment and spending it. When you receive payments that include ROC, the book value of your investment is reduced by the amount of ROC. This means that your capital gain when you eventually sell the investment is higher. For example, Rocco borrowed $100,000 to invest in a T8 fund. He received $8,000 per year in monthly payments and paid no tax on them because they're ROC. They're just the capital. It's the original capital he invested. So this has two issues. For one, the ROC reduces the deductibility of the investment loan. After 1 year, the interest on only $92,000 of the loan is tax deductible. After 2 years, only $84,000. So Rocco must track this on a spreadsheet to accurately record the interest deduction on his tax return. If part of the ROC payment is used to pay the interest of the credit line or paid onto the tax-deductible credit line, then it does not reduce the deductibility. This can become complex to track. The other issue is that ROC means a larger capital gain in the future. Rocco's $8,000 per year payment were tax-free for the first 12 and a half years. At that point, the book value of the investment will be reduced to zero because it's reduced by each ROC payment. So all ROC payments become taxed annually as capital gains after that point. So Rocco sold his investment 20 years later. He was fortunate that he still had $100,000 after having paid out $8,000 per year every year. He thought there would be no capital gains since the investment had the same value as when he invested. However, since the book value was zero, he had a $100,000 capital gain on sale. So the Smith Manoeuvre should generally only be considered if you need the cash flow and understand the tax consequences. You should be careful with any investment that pays return of capital. However, the Smith-Snyder is the main way that you convert your Smith Manoeuvre into retirement cash flow after you retire. Number 7, the Rempel maximum. Now, I created this strategy for the very small number of clients that want the maximum possible wealth building they can do with their given cash flow. It's only suitable for people with very high risk tolerance, focused on building up the largest nest egg they can. So instead of investing the principal portion of each mortgage payment, you borrow a large lump sum to invest so the interest payments are equal to the principal portion. You could use either a credit line or investment loan. So, for example, Mark wanted to aggressively grow his wealth. His mortgage payment paid $500 per month principal on his mortgage. Instead of investing the $500 per month from his credit line, he took out an investment loan of $150,000 at 4%. He used his credit line to pay the interest payments of $500 per month, so it did not come from his cash flow. He only had to make his regular mortgage payment. So with the plain Jane Smith Manoeuvre, Mark would have started with zero and invested $500 per month. With the Rempel maximum, he invested $150,000 once and nothing monthly. His cash flow is the same with either strategy. Mark wanted to grow his wealth and was sophisticated enough to tolerate the much higher risk. He was confident with effective investments, the $150,000 would grow much faster than starting with zero and investing $500 a month. People that try to maximize their long-term growth by trying to do the life cycle investing, which I have a video about, often do the Rempel maximum or the triple top-up. And strategy number 8, the triple top-up. So this strategy is the same as the top-up, except that you can also get a 3-for-1 investment loan. If you have $100,000 credit available, some companies will lend you another $300,000 if you pledge the $100,000 in qualifying investments. This strategy is also for the very small number of clients that want the maximum possible wealth building and is only suitable for people with very high risk tolerance focused on building up the largest nest egg they can. The total amount borrowed may be more or less than the REPL maximum depending on your situation, and it might require more cash flow to make it work. For more unconventional wisdom insights, follow this podcast and share it with your friends. I sometimes refer to a chart or image. Don't worry, if you want to see the chart, it's on my YouTube channel in this video with the same name. You can be the first to receive all my new podcasts by subscribing to my email list at www.edrempel.com. My services and costs are at edrempel.com/help. You can request a free 30-minute consultation at edrempel.com/talk or share feedback and topic ideas at edrempel.com/feedback. All right, is it legal? Is the Smith Manoeuvre legal? So yes, there is generally no issue with the tax deduction as long as you follow the tax rules. You are only deducting interest borrowed to invest, which is the same tax rule most businesses use. The main tax issues to maintain tax deductibility are these. Number one, tracking. It's critical to always be able to trace that any amount borrowed was invested and stayed invested. So, number two, keep tax-deductible credit lines separate. Do not commingle deductible and non-deductible debts, and do not commingle leveraged investments with non-leveraged investments. Number three, the current use. So the CRA is concerned with the current use of money borrowed, not the original use. So if you borrow to invest and then later cash in the investment to spend, your credit line is no longer deductible because the current use of your money is your spending. Number four, non-registered or corporate investments. So the investments cannot be in a registered account, such as RSP, TFSA, or FHSA. Only taxable accounts, such as non-leveraged investments or investments held inside a corporation, in some cases, are eligible. Number five, expectation of income. Your investments should be reasonably expected to be capable of paying income either now or in the future. This is often misinterpreted as the investments must pay dividends or interest. In general, almost any stock or mutual fund is fine, even if it does not pay a dividend, as long as its prospectus does not prohibit it from ever paying a dividend. All that's necessary is a reasonable expectation that the investment could pay a dividend or interest at some point. So tax-efficient corporate class mutual fund or stocks like Warren Buffett's Berkshire Hathaway that never paid any taxable distributions are normally fine. However, swap-based ETFs, options, or crypto that cannot possibly pay income are normally not eligible. Number six, selling investments. If you're selling in any investment, the lower of the amount invested or, actually it's a book value or the proceeds of selling, whichever one is lower, must be paid down on the credit line, or else the interest on that amount of the credit line becomes non-deductible. Number seven, taxable investment income. The general rule is that you receive taxable income from your investments, such as dividends or a capital gains distribution. You can use that cash for any purpose without affecting the deductibility of the credit line. You must clearly be able to trace the cash you withdraw to the taxable income. So, for example, Nancy borrowed $100,000 to invest. Her investment rose in value to $110,000. Then she lost her job. When her employment insurance ran out, she decided to cash in $10,000 to make her mortgage payments. She was glad to have these investments to support her in her emergency. Now, Nancy thought she was only withdrawing her gain. However, the book value of the $10,000 she sold was $9,091. The result was that she had a capital gain of $909. And however, $9,091 of her investment credit line was no longer tax deductible. If she wanted to withdraw only the $10,000 gain, she would need to sell the entire $110,000 in order to trigger the $10,000 capital gain, then withdraw the $10,000 and then reinvest the remaining $100,000. And number eight, tax rule, return of capital. If you receive any payment from the investments that are tax-free because they are return of capital or ROC, such as from a T fund or an ETF, that amount must be paid onto the credit line, or the interest on that amount of the credit line is no longer deductible. Most investments with a fixed payout include some ROC, even if it's only a modest amount that you can only find out on their T5 slip after year end. If you receive any ROC, you need to track how much of your investment credit line is still deductible to do your tax return each year. Okay, what's the best way to invest with the Smith Manoeuvre? So investments with the Smith Manoeuvre should be ones that you expect to provide significant and reliable growth over the long term, be tax efficient, possibly more conservative than other investments such as RSP, and should be quality investments that you will be confident with during a large market crash. So investing tax efficiently can significantly increase the benefit. Capital gains and dividends are taxed at preferred rates, but the lowest tax is by far is deferred capital gains. The most tax efficient investments pay little or no taxable income, defer most or all of your gains far into the future when you start withdrawing in retirement. Meanwhile, you can still claim your interest deduction each year. So the key to effectively implementing the Smith Manoeuvre is to have investments that you will still be confident with after they fall significantly in value. The Smith Manoeuvre is borrowing to invest, which is a risky strategy. It should only be done with a long-term horizon, preferably 20 to 30 years or more. In that time, the stock market is very likely to have some major market crashes or bear markets. It's critical that you can maintain your investments through these bear markets. If you sell even once in the 30 years after a 30% decline, you have severely reduced the effectiveness of the Smith Manoeuvre for the entire period. So you've locked in that loss. In short, any investment that you would sell if it declined by 30 to 40% is not a good choice. If you'd sell your investment after a decline, then the Smith Manoeuvre is probably too risky for you. You need to be able to remain invested through the inevitable bear markets. The Smith Manoeuvre is most commonly done with equity, that's stock market investments, such as mutual funds or segregated funds, ETFs, or individual stocks. And generally, it is best to avoid individual stocks and funds restricted to specific sectors, since they're usually riskier than broad-based funds. Focusing on global equity mutual funds or ETFs with a buy and hold philosophy is generally the most effective. This gives you broad diversification and reduces the temptation to market time. Studies such as the Delaware study, which show that investors lose an average of 6% per year by regularly moving investments to whatever has been outperforming well recently. Most investors buy high and sell low over and over again by buying investments that are in currently popular investments and then sell it later on when it's not popular. So buy and hold investors tend to have higher returns and pay less tax. Our process is that we work with a portfolio manager who finds the world's best investors. He calls them all-star managers. His fund managers have long-term track records outperforming their index after all fees. I believe the ones he's picking, their outperformance results from skill. I invest 100% of my personal investments with this portfolio manager with a very similar portfolio. Investing with all-star managers gives us the confidence to stay invested and even buy more at market lows. For example, after the market crash of 2008, I remained completely confident our fund managers would eventually recover the loss, and even published an article just a few weeks from the bottom in March 2009 called How to Take Advantage of the Market Crash of 2008. So I was, even though the market had been down 40% over 6 months, I was not at all worried about them. How can I learn more and find whether the Smith Manoeuvre is right for me? So if you think the Smith Manoeuvre might be suitable for you, then you should discuss with your financial planner whether or not to include it in your retirement plan. So we offer a free 30-minute consultation. There's a link on my blog to see whether we are a fit to work together. For help in getting the best readvanceable mortgage for your situation, check out our free Ed's Mortgage Referral Service. There's, again, a link on my blog. We know the advantages and disadvantages of all the readvancement mortgages available in Canada and have contacts and experience with most of them. If your mortgage is not due yet and you want to start sooner, fill out both the Ed's Mortgage Breakings Calculation and Ed's Mortgage Referral Service. You fill out both forms, which are both on my blog, to find out whether or not paying the penalty so you can start now is worthwhile in your situation. All right, thank you for listening. What you've learned is, what is the Smith Manoeuvre? What are the benefits? What are the risks? How do you manage the risks? How do you implement it? How do you avoid having to use your cash flow? How long should you ideally do the Smith Maneuver? Are there really 8 Smith Maneuver strategies? Is it legal? What's the best way to invest with the Smith Maneuver? How can I learn more and find out whether the Smith Maneuver is right for me? So thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog for a full-service financial planner in Canada. It's just my name, edrempel.com, or it's unconventionalwisdom.ca. Notice it's .c. I didn't get .com because it's in Canada. If you want a free 30-minute consultation, just go to edrempel.com/talk. If you subscribe to the blog, podcast, and YouTube, all that means is you'll get an email once a week with my new post. My podcast is edrempel.com/listen, and YouTube is edrempel.com/watch. Thanks for listening, and we'll talk to you next week. Thank you for listening. For more unconventional wisdom insights, follow this podcast, give it a review, and share it with your friends. Be the first to receive all my podcasts by subscribing to my email list at www.edrempel.com. My services and costs are at edrempel.com/help, and you can request a free 30-minute consultation at edrempel.com/talk. I often cover listener questions, so if you have a burning question or topic on which you'd like to hear unconventional wisdom, please ask or share feedback at edrempel.com/feedback. See you next week.